If you're thinking about starting your investment journey in 2026, hold on, because the next 8 minutes could save you from making mistakes that take years to recover from. I'm going to cut through the noise and give you the real fundamentals you need to know before you put a single dollar into the market. No fluff, no get-rich-quick schemes, just what actually works. And more importantly, I'm going to show you why starting imperfectly is better than waiting for the perfect moment. The foundation. First things first. Before you even think about investing, you need to have your financial house in order. And I'm not talking about being perfect, I'm talking about being prepared. Do you have an emergency fund? If not, stop right here. You need 3 to 6 months of living expenses saved up in a high-yield savings account before you start investing. Because here's the thing, the market goes up and down, and if you need to pull money out during a downturn to cover an emergency, you're going to lock in those losses. Next, high-interest debt. If you're carrying credit card debt at 20% interest, paying that off is your investment. No stock market investment is going to reliably beat that return. Get rid of it first. Once those boxes are checked, then we can talk about actually building wealth through investing. But here's something that might surprise you. There is no single right way to invest. People invest differently based on their income, their lifestyle, their goals, and their personality. Some people like structure. Some prefer simplicity. Some want to be involved. Others want to barely think about it. The best approach is not the most impressive one. It's the one you can stick with comfortably. How people actually start. Most beginners naturally fall into one of two approaches when they start investing. And neither is better than the other, they're just different. The first approach is investing small amounts regularly. Maybe monthly, maybe quarterly, or whenever income allows. This feels manageable, it reduces pressure, it fits easily around your life, and most importantly, it helps build the habit. You don't need a large amount to begin. The purpose of starting this way isn't immediate results, it's familiarity and consistency. This approach is popular because it removes the fear of getting it wrong at the start. The second approach is investing larger amounts occasionally. Maybe you get a bonus, maybe you've built up savings, or you have a one-off amount to invest. This can accelerate your progress and feels decisive, but it requires more emotional comfort because the amounts involved feel more meaningful. Both approaches are completely valid. What matters isn't how you start, it's whether you're comfortable staying invested afterward. And here's the thing about staying invested. Investing is something you set up, not something you constantly manage. Once it's in place, it should run quietly in the background of your life. You don't need to watch it daily, adjust it constantly, or talk about it often. In fact, the less attention it demands, the better it usually performs. Good investing often feels underwhelming. That's not a flaw. That's the design. The strategy. Now let's talk strategy. Here's what most beginners get wrong. They think investing is about picking the next Tesla or finding that hidden gem stock. It's not. For most people, the winning strategy is almost boring in its simplicity. Index funds. Specifically, low-cost index funds that track the total stock market or the S&P 500. Why? Because they give you instant diversification across hundreds or thousands of companies, they have incredibly low fees, and historically they beat most professional fund managers over the long term. Why does simple beat clever at the beginning? Because beginners often assume that more complexity leads to better results. In reality, complexity usually creates confusion, second-guessing, and unnecessary stress. Simple investing approaches are easier to understand, maintain, and stick with over the long term. That's why many successful investors intentionally keep things boring. They're not trying to be impressive. They're trying to be consistent. Time in the market beats timing the market. Every single time. You know what's better than waiting for the perfect moment to invest? Starting now and investing consistently. This is where dollar-cost averaging comes in. By investing the same amount regularly, you buy more shares when prices are low and fewer when they're high. You're basically removing emotion from the equation. And here's something many beginners don't expect. The most important early decision isn't what you invest in. It's how involved you want to be. Some people enjoy checking occasionally. Others prefer to barely look at it at all. Neither is right or wrong. but knowing yourself matters. Choosing an approach that matches your personality reduces the chance of emotional decisions later. The pitfalls. Let me tell you what's going to try to derail you in 2026. Social media investing gurus promising 10x returns. Ignore them. If someone had a foolproof way to make massive returns, they'd be on a yacht somewhere, not selling you a course. FOMO on meme stocks and crypto hype. Yes, some people made money on GameStop and certain cryptocurrencies. Most people lost. Don't let other people's highlight reels pressure you into risky moves. Panic selling during market dips. The market will drop. That's not a bug, it's a feature. If you sell every time things get scary, you're going to miss out on the recovery that always follows. Remember, you only lose money if you sell at a loss. And fees. They seem small, but a fund charging 1% versus 0.1% can cost you hundreds of thousands of dollars over a lifetime of investing. Always check the expense ratio. But here's the biggest pitfall of all: waiting for perfect conditions. Many people delay investing because they want more clarity, more information, more confidence, more certainty. The problem is that clarity usually comes after you start, not before. Starting imperfectly allows you to learn through experience, build comfort gradually, and remove fear through familiarity. You're not locking yourself into anything forever. You're simply beginning. The first time you invest anything, no matter how small, something shifts. Investing stops being theoretical and starts being real. That familiarity matters more than early results. Not because everything is perfect, but because it's no longer unknown. What to focus on? In the early stages, your focus shouldn't be on maximizing returns, finding the best option, or optimizing every detail. It should be on understanding the process, staying calm, and building consistency. The goal isn't to win. The goal is to stay invested long enough for investing to work. So here's what you should actually focus on when you start. 1. Open a retirement account. If your employer offers a 401k match, contribute at least enough to get the full match. That's literally free money. Then look into opening a Roth IRA if you're eligible. 2. Choose a low-cost index fund. Something like VT-SAX, VTI, or an S&P 500 index fund. Keep it simple. 3. Automate your investments if that fits your approach. Set it and forget it. Consistency beats perfection. 4. Increase your contributions over time as you're able. Got a raise? Consider investing a portion of it before you get used to the extra money. And 5. Educate yourself continuously, but don't let learning become a substitute for action. Read books like The Simple Path to Wealth or The Intelligent Investor. But remember, confidence comes from doing, not just reading. Reading helps. Understanding helps. But confidence usually comes from action. Look, investing isn't complicated, but it does require discipline and patience. By now, investing should feel less intimidating, more practical, and more personal. You're not meant to have all the answers yet. You're meant to feel capable of starting sensibly. The best time to start was yesterday. The second best time is today. You're not trying to be perfect. You're trying to begin. Slowly, calmly, with understanding. 2026 can be the year you actually start building wealth. Not because you knew everything, but because you were willing to start anyway.